Hello. Today, we will talk about the revenue recognition principle, otherwise known as the realization concept. So, to discern and more easily understand the definition of the revenue recognition principle, I will define what is revenue. Revenue is an increase of resources resulting from the sale of goods or the provision of services. For example, receiving $80 for mowing a lawn, since you will have $80 more than you did previously because you provided service. So now we can go back and ask, so what is the revenue recognition principle? It is a principle that revenue should be recorded when a resource has been earned, and not just when the cash is received. So now we're moving on to examples. For example 1, Bob orders apples from Jenny, the woman to the right, paying her on the same day, which is the 15th of March. Then 3 days later, on the 15th of April, he comes back to collect the apples that he has ordered. In this scenario, the revenue is recorded for the month of April, the next month. So in this scenario, this is a deferred revenue, which is when cash is received before revenue is earned. To illustrate a more detailed example and a deferred adjustment, suppose a company sells 12-month subscription to its monthly magazine. On the 1st of October, the company receives a total of $1,200 for 20 subscriptions. Suppose further that the company prepares financial statements at the end of each month. As of the 31st of October, the company has provided 1 month of magazines and has therefore earned 1 month of revenue. Since accounting system does not yet reflect this earned revenue, the following adjusting entry can be made. And now, moving on to example 2. On the 25th of April, Bob helps the man Tim, the man on the blue shirt, to the left, to mind his house since he is going overseas, where Tim promises to pay him when he comes back. 30 days later, Tim arrives home, and thus pays Bob for his service. In this case, the revenue is recorded before cash is paid. This is an accrued revenue. An accrued revenue is when cash is received after revenue is earned. To illustrate a more detailed example and an actual revenue adjustment, suppose an accounting firm agrees to provide a service to a client for a $1,000 fee. The firm completes its work on the 23rd of September, bills the client and receives payment on the 21st of October. Now in terms of the actual basis, the accounting firm must record $1,000 of revenue on the 30th of September. Thus, when the customer pays cash on the 21st of October, the following entry is made. Thanks for your time.
Created using Powtoon.